Hello everyone and welcome to episode 2 of Stock Market Lessons. Hope you enjoyed episode 1. Now we're going to get right into this with a very, very important one to me. What is a dividend? So starting off here, the definition would be a sum of money paid regularly, typically quarterly, by a company to its shareholders out of its profits or reserve cash. And the thing to note about dividends, if you get paid a dividend by a company, it is taxable as income. So that is something to consider as well. So that's just the definition there. We'll get into some more details now. So most companies pay a dividend typically quarterly, right? That's according to that definition. But others do pay either annually, biannually, monthly, or there are special dividends as well. So you're annually, obviously, once a year, biannually, once every 2 quarters or half a year, monthly, every month, pretty self-explanatory, and special dividends could be announced at any time for any specific date and any amount. It doesn't necessarily have to flow with their natural dividend payout schedule as is. They could just announce it at any time. So a couple examples here. Disney is a biannually payer. They pay 88 cents. Currently, they pay 88 cents per share biannually. I believe once in June and once in December. So if you look at a company like Disney, you can see they're paying biannually. That's just something they've always done. I haven't looked into the reason for it. I'm sure they have a good reason, but it's pretty interesting. Next, we're going to look into a stock I personally enjoy myself, Apple Hospitality, ticker symbol APLE. And this company pays 10 cents monthly. So every month, you're getting 10 cents for every share you own. So put that into consideration. If you own, 10 shares of the company, you get $1 every month. If you own 100 shares, you get $10 every month. Something to consider. Obviously, this is a good stock. Obviously, I recommended purchasing it before, but something's nice about having that monthly income that you can use for whatever you want. You could use it for repurchasing shares or whatever it might be. And finally, an example of a special dividend is Ford. Last year in January, they announced an additional 13 cents special dividend on top of their normal 15-cent dividend. So they paid 28 cents as opposed to 15 cents in January of last year. So this was just a one-time thing, mostly due to the release of the new tax bill in 2017, which lowered corporate tax rate. A lot of companies had extra cash. Some people increased their dividend off of it. Ford paid a special dividend to shareholders here. A lot of companies also paid special dividends, so 2017 to 2018 was a good time for special dividends. There were plenty to go around, but companies still do occasionally. It all depends on the situation. If they just want to pay their shareholders back, they might just announce a special dividend out of nowhere. So it's always something to consider when looking at these. So now we're going to get into dividend yields. Obviously, that's a very important statistic we've talked about previously. So dividend yield is the ratio of the company's annual dividend compared to its share price, calculated as the annual dividend over share price. So if it's the annual dividend, if they pay quarterly, you need to multiply each quarterly dividend by 4. That's how you get how much they're paying annually. And we're going to have a couple examples here. So Company A pays $1 per share annually with a share price of $20. So here we're going to do that $1 divided by the $20 share price, which is going to give us 0.05, or it'll be a 5% yielding company. Company B pays 45 cents quarterly with a share price of $62 a share. So we're going to go ahead and get the annual dividend first, which is going to be $1.80. Then we're going to do that $1.80 divided by the 62 and get 0.029, which is a 2.9% yielding company. So obviously, for the most part, we have very simple ways to get these calculations, and we don't typically have to. Just go on any website out there, and they will include that dividend yield. But if you want to double check the math, or if you want to know how to do the math, I think it's perfectly good to know the formula and how to actually calculate them. Dividend yields are obviously very important. We're going to see what is a good yield. As one tip of advice, I would say avoid a company yielding over 10%. These typically are referred to as dividend traps. Dividend trap being a company that attracts you with the yield, so you invest in it, but shares decrease in value so much that you end up losing money. And there are plenty of reasons why companies would have a 10% yield. Sometimes companies pay a consistent dividend, but their share price just keeps falling, and that increases their yield if you think about it. So if they're paying the same, if this quarter or this year they paid the same dividend as they paid last year, but their share price is less expensive, they're going to have a higher yield because that share price is cheaper. So if there's a 10% yield or over 10% yield, there's probably a reason for it, and it probably is because the shares are devalued. Now, whether or not you look at that stock and you consider it a buy is entirely up to you, but as a place of being safe, I would say these companies typically are ones that are on a bad path and end up continuing to decrease that share price. So that is a situation where the yield would not be worth it because you wouldn't be making money in the end. Either the stock will get delisted, go bankrupt, or you'll end up selling it at a loss. So that's something to consider. Always look for good paying companies. We'll get into those in the future. And it certainly depends on the company what a good yield is, i.e. looking at their payout ratio. And their payout ratio is the portion of earnings paid to shareholders via dividends. So naturally, you're going to look for a company that is paying less than 100% payout ratio, which I think is pretty obvious there. A company can't be paying more than what it's earning just due to the fact that that means they're not earning anything. They're losing, and they're losing profit, and they're not making money. So obviously, payout ratio is an important thing to look at. Companies that pay over 100% typically can be a little bit scary to mess with, but it does depend on the company. An example of that would be the difference between just normal stocks and real estate investment trusts. So these real estate investment trusts have tax incentives to pay over 90% of their 90% of their earnings to shareholders, as that reduces, I believe they have a tax break for that if they meet that quota, and if they need to stay listed, they have to meet that quota as well. They have to be paying out over 90% of their earnings. So these companies are usually going to have payout ratios very close to 100% or over 100%. So obviously it depends on the company, but if it's just a normal company like a Pepsi or something, and they're paying over 100%, it's something to look out for because they're spending more than they're making. And as I talked previously, just the other day, I don't really like companies that aren't in the business of making money. That's my perspective on it. So obviously take an eye out, look for these payout ratios. Now, is a low yield a bad thing, something under 1%? I'm going to say no. No, it's not. In my opinion, as long as a company's paying a dividend and it's sustainable, it's a good dividend. So even if they're yielding less than 1%, if they're continuous with that dividend and they're not decreasing it, and they have enough money to afford that, they have enough, their payout ratio isn't over 100%, and they're still making money, I think it's perfectly fine. Obviously, I enjoy companies that pay dividends personally, so anything that pays a yield for me that I think is a good business model, I love it. Love it, love it, love it. So I have a couple of examples of good dividend companies that have continuously grown their dividend over the years would be Apple, ticker symbol AAPL. Everyone knows Apple Corporation. iPhones, smart or Apple Watches, MacBooks, all of these things, iPads. So Apple pays around I want to say only 1.3% dividend yield, but at this point, they're paying something, and they're still a company that's growing. So I love Apple. Love Apple. It's a great stock. AT&T, very high yield company, somewhere around 6-7% in terms of yield. Maybe upwards of 8 now. But I know the share prices recently have been going up a little bit, so that yield went down just a little bit. Ticker symbol T. They pay a very high dividend yield, and it's consistent with them, and they're not exceeding payout ratio. Always a good company, and they're still growing. So Walmart, ticker symbol WMT. Walmart pays around 2.5% average in terms of their dividend yield. So they pay quarterly. It's fantastic. I think right now they're paying 53 cents a share. Walmart's been continuously growing that dividend just regularly, and they annually increase by at least around 4% each year in terms of that dividend. So always exciting stuff for them. Walmart always pays out dividends, and they print money, so that's pretty much why they're able to do this. And finally, Coca-Cola. I believe they have increased their dividend for at least 20 consecutive years at this point. Coca-Cola is always a very safe stock, around a 3% yield on the company, and they are just a very good stock to look at. So Coca-Cola, if you're looking for dividends, it's very consistent in terms of share price. Not much room going on there, not much room of growth, but you can guarantee yourself money based off of these dividends. So why would you not just only invest in companies that pay dividends? There's a couple reasons for this. So typically whenever these companies pay out these dividends, the shares get devalued on that day. The day of the payout, that is. So if it's a company paying too high of a yield, and it's not sustainable and their business model isn't growing and people aren't buying that stock back, once this share depreciates, it's not going to go back up. Now, this isn't the case. It's not often the case, but for some of those companies that pay a dangerously high dividend, this is the case. That dividend devalues the shares, and people aren't repurchasing shares to bring that share value up. Another thing to mention is when a dividend gets cut, share prices tumble. If you look historically, companies that have cut their dividend, you don't want to be there the next day. You don't want to be holding that stock the next day because it's going to get pummeled. Now, this doesn't mean it won't recover, but in all honesty, typically the stock gets absolutely decimated the next day that they announce it, that they've announced a decrease, that is. Because a lot of these longtime shareholders that were very confident in this company, that thought things were going to be great, ended up getting less money now, so they sold out and went to better companies. So that can happen as well. That's obviously a risk of dividend investing. And typically the higher growth companies do not pay dividends. There's what I refer to as the maturity of stocks. So we're going to compare Apple and Facebook here. So Apple is a company that's been around so long, in the market so long, and it didn't used to pay a dividend. I would say when it matured is when it started to pay a dividend. So it went from that growth status to a more of a dividend payer, consistent dividend payer status. So when a company grows finally, when it's finally reached its peak growth phase, I believe it matures. So a company like Facebook, ticker symbol FB, by the way, a company like Facebook right now is in its growth phase, absolutely. But 5-10 years down the road, once it's matured, they're a company that right now is, I mean, I'm not joking here. They also print money. They print money ridiculously. They make so much profit, it is insane, and they have so much cash on hand. So down the road, they're a company that could pay a good dividend to its investors. And a lot of the times, if Facebook were to finish this growth phase and then announce they're paying dividend, I guarantee a lot of people are going to flock to the stock and increase share price that way too. Obviously, dividends, I don't necessarily care about share price. I just want a sustainable dividend because I don't want to sell the stock typically, but it all depends. So it's important to look for the maturity and what life cycle the stock is in. So once it matures out of that growth phase, if they have enough cash, they're making enough cash that they can actually reinvest that into its shareholders. It's something to look at as well. So that's an option for when you don't want to invest in necessarily a company paying dividends right now. They might pay dividends down the road. One final addition, I would like to add another important part of dividend investing is DRIP or dividend reinvestment program. So depending on your broker, they might offer an automatic dividend reinvestment program. Some you might have to do it manually though. I know on the Robinhood platform they do not offer a dividend reinvestment program. A lot of it is because they don't offer partial shares on stocks. But a lot of the other big companies that offer partial shares, such as M1 is a great example. They do automatic dividend reinvesting. So once they pay out that dividend, they're going to reinvest that into your portfolio. So that's something to consider as well. Anything that can automatically reinvest those dividends is certainly nice. So that way you don't have to. But otherwise, you can just take that dividend money and do whatever you want with it. Go get yourself some spicy nuggets from Wendy's. That's my suggestion. Spicy nuggets. You already know. Love me some spicy nuggets. I hope you enjoyed this lesson today. Please like and subscribe for more. Show me a picture of you getting some spicy nuggets. Buy me some. Sounds good. Bye.